Good evening, everybody. Greg McDermott with Cyber Trading University welcoming you to our Options Advantage webinar. We appreciate you being with us this evening. We are brought to you by our friends at FXCM. They're the sponsors of our event. I know everybody's probably had a very busy day, so let's get right to it. First, the CTU risk disclaimer. I'll leave that up there for a moment to everybody to take a read. Next, about Cyber Trading University. CTU has been an educational trading institution since 1995. Cyber Trading University established itself as a leader, first by working directly with the SOES trading firms to teach them how to day trade. CTU was one of the first to establish itself as a quality stock market trading school. Each instructor, including myself, has a minimum of 6 years actual trading experience before they begin to work with students. Over the past 14 years, we've taught thousands of students to be successful and profitable traders. CTU's headquarters are located in the heart of the trading world in New York. So we say, my mother's favorite slide. That's me, Gregory McDermott. I earned my Master's of Applied Finance from Macquarie University while studying on a Rotary International Scholarship at Macquarie University in Sydney, Australia back in '89. Earned a Bachelor of Science in Financial Management at St. Joseph's University, 1987. I was a crude oil options trader at the New York Mercantile Exchange. I was the head options market maker for JAS Securities in Philadelphia at the Philadelphia Stock Exchange. While there, I managed our firm's portfolio risk for our team of 10 options floor traders, including myself, where I was a market maker in the Dell computer crowd, which at the time was the busiest equity option traded in the United States. I directed an off-floor trading unit for JAS Securities and qualified at that point as a DTR at the ISE or the ICE. Let me see if I can make this go that way and that way. And everybody should be seeing my screen now. Let me just see. See if I can make this move. I want to make sure everybody can see the screen now. Great. Awesome. There we go. Now I see it. So why trade options? There are a number of reasons why, if you're out there, you've thought about trading options, you have traded options, why you need to make sure you continue to use options as part of your trading. We're going to talk a number of reasons why there are advantages of trading options. Capital efficiencies, limited loss with risk reduction. Yes, with all respects to Warren Buffett, we're going to talk about the limited loss and risk reduction capabilities of options. Superior alternative to shorting stock. I think even Mr. Buffett couldn't argue with that one. Additional means to profit with greater choice. Position integrity after profit taking, something you clearly can't do when trading stocks. Timely and flexible portfolio protection. Income generation methods. Market noise cancellation. That's one of my favorites. So we're going to start with the capital efficiencies of trading options. Let's go with a basic tenet of trading. What do we know? That if we want to buy 100 shares of the infamous XYZ stock, you know what's amazing is that stock seems to sit at $100 or $50 depending on my slides. But XYZ this day is sitting at $100. We want to buy 100 shares. Well, we're going to need $10,000 in our account to be able to do that. $10,000 in capital to make that transaction. You know, that's a lot of money for not controlling that many shares of stock. Imagine if we took a stock like, oh, I don't know, Google, made that 500 and, where's it trading these days, 550-ish, something like that. You know, all of a sudden that becomes $50,000 to get 100 shares of Google. Or we could buy one January 100 call for $100, which would give us the right but not the obligation to buy XYZ stock for the price of $100 until January expiration, regardless of where the underlying trades. So that would cost us $1,000 in our account, which is a 90% discount. Now, there's a couple things we need to be clear about here when we're talking about why this is such a powerful tool. The one thing that it's not is it's not a way to trade stocks simply because you don't have the capital. Like it doesn't like, well, I should just, if I'm going to trade Google, I should trade options because Greg said you trade expensive stocks with options. No, that's not what I'm saying. What I'm saying is there are efficiencies to doing it that way, putting less money at risk. And it is one of the things that you can consider. I could show you now, we'll probably talk about it. You could use this as a way to replace stock. We'll talk about it coming up, but you could use it as a way to replace stock. There are a couple of different ideas, trading strategies you can use that will allow you to trade an option as if it were stock with some great benefit, and the first and most obvious being that it costs you a lot less money to do it. Now, what are you going to do with that money? Well, that's a $9,000 of savings. I mean, you could put that money into a money market, earn, albeit a modest return on your investment. You could invest via options in other companies. You could expand your portfolio, so put more money on the table. Or you could utilize alternate investments. Any of those things, it's still the money in your pocket. Making sure everybody's got us here. It looks like the sound is back on. Okay, just double checking. So the idea that you put less money at risk to control for a limited period of time the same amount of stock is a gigantic advantage. Particularly if you're looking to trade stocks, let's say you're more of a swing trader. So you're not day trading, maybe like the short-term trading like the cyber group's going to do. And we're going to talk about what a great deal we've got for you to join the cyber group at the end tonight. But if you had more of a swing trading strategy, the options allow you to get around some of the difficulties you have when margining a position that you may keep for a significant period of time. What I mean by that is, a couple of days, a week, maybe 2 weeks, could be a month or so. That can get to be a very taxing on the capital in your account, where the options allow you to have a more economical use of your money. In fact, I think you should be able to decide who's using your money, not necessarily anybody else. So let's take a look at, for example, let's say our stock is trading at $58.53. It's dropped precipitously, obviously, since the $100 market was at just a few moments ago. Or scenario 2, let's say we buy October 55 calls and we pay $3.90 for the exact same stock. And there are 2 expiration scenarios. So we're trying to compare what's the difference between stock and options, in this case call options, and buying them. If the stock closes at 60 or if the stock closes at 55. Well, with a stock position, we paid $58.53, we sell the stock at 60, 2.5% return on our money. Not too bad. Our October 55 calls, paid $3.90, sold them for $5. Based on a rate of return, that's a 28% return on the money that was at risk. Options do provide you leverage, but is leverage always a good thing? Let me show you the dark side. The underlying stock falls to $55. The stock we owned drops $3.58 or 6%. The October 55 calls that we bought, they're worth 0. 100% loss of our investment, although the dollars are very, very similar. So you have to be careful. This leverage thing, when you're buying calls, on some level you are renting them. They will expire. Even if you buy options that are January 2015, January 2016, those will eventually expire. The advantage to owning a stock is that, in theory, you can own the stock forever. So there is a little bit of an advantage, but most times when you're trading, you're not buying a stock to own it forever. So the ability to replace the stock with options, particularly for that that medium to long-term trade, does provide a great advantage. Now this is the one that I like, that most people come to us and are a little skeptical about: limited loss or risk reduction. Well, I'm going to take a step back. What is an option? Well, it's a derivative instrument. Well, Greg, what the heck's a derivative instrument? Stop using the SAT words for me. Well, a derivative instrument is, in this case, a financial instrument that derives, hence the word, its value from something else. And Warren Buffett famously said that derivatives are the weapons of financial mass destruction, and they can be if used improperly. If you're selling collateralized debt obligations on an underlying that is not what it purports to be, go look up the history of 2008. They can be devastating. If you're looking for a good book, a great one to read is Michael Lewis's The Big Short. In fact, I just finished his most recent book, Flash Boys. Even more interesting. That's my unsolicited recommendation of both of Michael Lewis's books. He also wrote Liar's Poker, which I'm a huge fan of and have read a couple of times. He's written The Blind Side and a couple of other things. So enough advertising for Michael Lewis. But the limited, when done improperly, yes, you can put yourself in a situation of dire risk. But what I'm going to tell you is, when you're talking to me, when I'm talking to you about options, we are never, ever going to put ourselves in a position where we could open you up to unlimited loss. And what I used to tell the guys and the women who would come work for me, every day we would get, this was a while ago obviously, big reams of paper printout of all of our positions. And each one would have this P&L chart, profit and loss chart, and it would show you where will your position make the most amount of money, where will your position make the least amount of money. And I would take a new trader and I would say, hey, you see this point here where you make absolutely the most amount of money? And their eyes would get really big and they would say, yeah. And I'd say, don't worry about it. It's never going to happen. And if it does, trust me, I can handle the upside. And then I would point out to them the point on the chart where they would make, lose the most amount of money and could possibly blow out the firm. And their eyes would get really, they'd drop their head and they say, yeah, I see that. It's like, look, that we have to worry about every single day. And one of the ways that people who are out there teaching will tell you that you can make money are strategies that can, if you don't know what you're doing, become weapons of financial mass destruction. I was at a show in Vegas years ago, and a gentleman who's still out there teaching brought some people up on stage and showed them this 1x2 vertical spread that they could do for a credit. And it was simply because it was a credit. Well, he showed someone how they could buy one option and sell the two upside calls above it. And I turned to the nice lady next to me and said, I wouldn't do that trade with his money, because yes, if the stock stops at a certain point, it could be a very profitable trade. But if it goes against you, you could blow your account out. And we're never going to talk about that. We're always going to be talking about positions where even if you're selling, you're going to be selling spreads, you're going to be hedged, and that's how you can bring about limited loss. I'm going to show you one of the key features to ensure your position. Let's say the stock, our infamous XYZ stock, goes Enron. And for those of you that don't remember, Enron went to zero. Famously, the company I worked for had a gigantic spread trade on convertible preferred against preferred stock. And I just was being told by my friend, the CFO, he said, look, as long as this company doesn't go to zero, we're going to win big on this trade. Smash cut, it goes to zero, and the firm takes a gigantic loss. So I'm familiar with an Enron situation. In this case, I was up close and personal with it. But our stock goes Enron. Well, we've got a stock position that has $58,530 of exposure. Why is that? We own 1,000 shares of stock that's trading at $58.53. But we have a call position. We own 10 of the calls, and we have exposure of $3,900. If the stock goes to zero, what's the most we can lose with each position? dramatic pause, all of it. Inevitably, you can lose all the money that you put into that trade. And so our maximum loss when buying these call options is the premium that we paid. In this case, $3.90 for 10 January options. So we can only lose $3,900 regardless of what happens to the underlying stock. We can only lose $3,900. If we own stock that's trading at $58.53, doesn't happen very often, but it can, and occasionally they do, go to zero. Inevitably at this point, and it comes up later in the presentation, but inevitably here someone is thinking to themselves, yeah, Greg, well, I would have had a $50 stop loss order in, so I wouldn't be at risk. And the reality is, much more often than you think, even with an active stop loss order, you are at risk, because the majority of the things that happen that are bad news happen while the market is closed. And for those of you that don't know, the stop loss order does not guarantee a price. What a stop loss order is an order that trades, sits on the book, and once the underlying stock, in this case stock, trades at or below the stop loss price, that order then becomes a market order and is to be executed at the best available bid. So if in our situation here, the stock closed at $58.53 and opens the next morning, the first print is $1 and the second print is $1, you would have sold all of your stock on your $50 stop limit at $1. It's on a slide coming up, but I'll tell you now, stop losses are notorious for not being there when you need them. The protection of an option is there. You always have, if you buy this call, the right but not the obligation to purchase the underlying stock at a specific price until expiration, regardless of the time of day. So you can only lose what you put in if you buy these calls, regardless of where the underlying goes. And that brings you to one of, I think, the most important things, not just in trading options, but it's clearly important there, but trading anywhere. One of the things you have to learn, which is why you need to take some educational courses and get this shown to you in a number of different ways. But the beauty of options, when you buy an option, or let's say you buy a vertical spread, who knows, maybe you sell a vertical spread. What you need to know is, the first thing you need to know, where's my risk? What is my risk in this trade? You need to identify the risk. You need to look at, I talked about the traders that work for me. You need to figure out, where is my downside? Then, at some point, after you've established that, and you think you might have an entry into a trade, try to find if there's enough upside in the trade to make it worthwhile for whatever your risk-reward tolerance is. One of the huge mistakes that people make is that they see a trade and they think, wow, this stock is going to go from 50 to 70, so I need to buy calls, buy the stock, whatever it may be. And they don't think about, what if I'm wrong? I've been married for a very, very, very long time, so I'm very well versed in the fine art of being wrong. Ask my wife. I'm wrong a lot. And you need to understand that when you go into a trade, you need to have a plan, and the first thing you need to do to execute that plan is, where am I getting out? That's what you need to concentrate on, not where am I cashing in my chips so that I can go buy that Ferrari that I always wanted, or my own private island. That's the wrong way. If you're looking for that kind of education, you don't have the right spot. But if you're looking for a place where we can show you and do this as a business, and when you're doing this as a business, the first thing you need to figure out is, where can I get out? And that's the beauty of options, because if you have the stock position, you have, during business hours, a relatively good handle on the risk in that position. But when the market closes, you're at risk, not with an options position. Regardless of where this underlying goes, you have the right but not the obligation. So you never have to, if it went to $10, you would just let the options expire. You'd lose your $3,900, you'd lick your wounds, and you'd move on. So that, to me, is the big advantage. I need to know, where am I going to get out? At If any of you have seen me when we talk in our cyber group that I join every day, I'm always looking at what's our risk, where's our downside, where do we get out? Like that's the first thing I look at. It's an old, some would say good, some would say bad, but it is an old trader habit of mine where I'm always looking at what's my downside. Because I said to the traders who work for me, and I'll tell you guys the same thing, I'm pretty good handling the upside and maximum profit. I had it happen once. And we had the trade of the day, which will never, ever happen again. And we spun it masterfully, and the guy who worked for me cashed out with a 7-figure payday. It was a beautiful thing. So remember, the long options, and that's what we're talking about here, either long options or spreads that are equal, which means if you buy one, you sell one normally within the same month. Once you start crossing months or changing strikes, you then put yourself at some risk, some spread risk that we wouldn't be comfortable with. So we'll either be talking about vertical spreads, spreads within the same month, buying and selling exactly the same amount of options, or in this case, buying long options and owning them. As I said, don't have to worry about the stop order, and it is a full-time hedge for you. Now here's one, the superior alternative to shorting stock. All of you in this call have probably traded stock in the past, and you've had lots of reasons why, and I'm going to list them here. You may not have been able to short stock, not enough cash to cover your margin requirements. There's SEC rules that can prevent you from doing it. Your broker may just flat out not allow you to short. You do put yourself in an unlimited upside risk position, and there is a lot of times maybe not availability of short stock. I'm going to start with the one at the bottom, and this is a real life example. When I traded Dell Computer so many years ago, it used to be, it was the busiest equity option traded, but what most people don't understand is that you can create options, but there's only so much stock float in a stock. So for you to be short a stock, what do you need to do? Well, you need to borrow stock from someone who owns it. Well, there's only so much stock that's owned, so in theory there's only so much stock that can be shorted. Well, as traders, we would have short stock positions, and the nice young lady, Michelle, would come down to the crowd for a good number of weeks and would say, hey guys, there's 50,000 to buy because there was an imbalance, and if the brokerage firm could not match buyers, could not match short sellers with people who are willing to lend at a fee, they would have to pull your stock away. So she would say, hey, there's 50,000, and then it would inevitably get matched up at the end of the day, and it would not be an issue. Well, one day I come in, and my stock, my 10,000 short shares of Dell Computer has been taken from me. My boss, who was not the kind of guy who ever took no for an answer from anyone, got on the phone and screamed a blue streak up and down what was then Spear Leeds and Kellogg, which is now part of Goldman Sachs, and told them that you are never to take his, I'll leave out the colorful words, short stock again, which they never did. Luckily for me, that story had a happy ending. The stock opened up about a quarter. I was able to sell out the 10,000 shares that I was inadvertently long, reestablish my short position, and put a few bucks into the ledger for the good guys. So as you can see here, there's lots of reasons why people can't trade on the short side. And to me, it's not being able to trade on the short side limits the opportunities that you have when trading, because even in an underlying, whether it be a stock or a currency or a future, whatever it might be, even those that move what appear to be straight up have movements of up and down in between, and there's money to be made there. And if you're only trading the long side, you're limiting your opportunities. I mean, lots of people, to me, believe that just simply being short is, un-American. It's like rooting for Ivan Drago in Rocky IV. Like, we just don't do that. You don't root for Rocky. You root for Rocky. You don't root for Ivan Drago. Well, hey, look, I'm rooting for whichever way I can make some money. And down, up, I really don't care. And the ability to use options allows you to put all this behind you. You can develop strategies, whether it be simply buying a put spread, selling a call spread. Any of those simple strategies would allow you to profit if the underlying you're trading goes down with a negative. And again, there's no you're not precluded from doing that by any market regulations, simply by the amount of money that you have in your account. We've already talked about how advantageous it is to be able to trade options from a dollar's capital efficiency standpoint. So you can be long or short using any number of basic options strategies, or more complicated ones, but mainly the basic strategies of directional trading. You can be trade up or down using these, and again, you're not precluded from missing those down moves in the market. How many of you on this call mentally hold your hand up, feel like, oh man, the market was down today, so I had to sit on the sidelines because I don't trade in the down market? Well, there are lots of down days. Now, it doesn't seem like it over the last few years. The market has been seemingly moving up, but within those move ups, there's opportunity on the downside, and you don't ever want to leave opportunity on the table. And that's why it's such a great idea to have options as part of your trading strategy. Up, down, you identify opportunity, and you can capitalize on it very quickly using simple or complex options trading strategies. We got additional means to profit. Directional trading with options is really very, very simple. All you really need to do after, again, you've determined your risk and where can you get out, there's ways to trade that allow you to move, whether it be up or down. The simple purchase of calls or puts, hedge bullish or bearish strategies. And we talked about that. The things we'll talk about in our classes that are coming up with Cyber Trading University are making the right decisions about options. Whether when in the month, how long till expiration? Do I want to buy long to expiration? Well, what's your strategy? Do I want to buy in the money, out of the money, or at the money options? It really depends, and that's where the education comes in. You learn to become and this is really what my goal is when we bring anybody into our options classes. I want to take you from somebody who trades options to the point where you're an options trader. And in my mind, there's clearly a difference. It's about how do you look at the market, how do you draw upon your experience, how do you draw upon your education, and determine what's the strategy that will best suit what we believe will happen. A couple buddies of mine and I years ago used to have a trading room that I would join them in occasionally, and the three of us would talk on the call, just like I'm talking by myself now, but there'd be three of us on a call, and we would come up with opportunities. The other two guys were great chart guys, and inevitably the conversation, we'd have lots of people in our room once or twice a month whenever we would do it, and inevitably it would come down to okay, well, what should we do? We've determined what we think should happen based on a lot of technical analysis that they would do and other such data or information, and then inevitably they would turn to me and be like, Greg, what do you think we should do here? And then it would be my turn to come in and say, okay, well, if we think this, then we should try this option strategy or that option strategy. And we can take you in our training from the point where you clearly could never do that to a point where you'd feel comfortable doing it. And what that is taking you from someone who trades options to the point where you become an options trader. There are ways to even trade and profit with lack of movement. Now, again, if you own a stock and it doesn't move, you're in trouble. There's not a lot going on. You really don't have any real ways to make money. But with options trading and the strategies that are generally available out there, you can make money when stocks move sideways or don't move at all. In fact, you can even take the component of the option, the volatility, that sort of secret sauce, the hardest part about an option to gauge, to price, and you can trade simply the volatility, that feature, that portion of an options price. When we talk about options pricing in general, the way you price an option, call or put, has to do with the time to expiration, the strike price, the price of the underlying, the current risk-free rate, and then volatility. Well, all the pieces except really volatility are known. We know how many days there are at expiration. We know what the underlying is trading. We know what month. We know what strike. We know what the risk-free rate is. And the volatility is the piece where that drives the value of an option. So You can trade simply volatility. And what do I mean by that? You can do, calendar spreads and things that can take advantage of highly priced options in one month, lower priced in another. For example, let's say you've got a month where earnings are coming out. That month, normally that volatility will trade higher than the subsequent months. And there are ways that you can trade vol against vol almost regardless of direction. Although directional trading is the most common use for options, and particularly those who are trading from a swing or medium to long-term trading strategies. And you can also trade the simple passage of time. We've done it this week in our cyber group, Ken, which I told you I join every day. But we're looking to try to take advantage of the fact that over yesterday and today that we've got in the U.S. this Thanksgiving holiday, which will put a lot of trading on the sidelines. It will be next Monday before anybody knows it. And we've been trying to find ways to maybe capture some of that passage of time, that theta, one of the Greeks, that time decay. And we're going to use that as a way to try to generate some income simply by letting the clock tick. It's one of the key features of options that on the good and the bad, as soon as you buy an option, the moment you hit the button and you own it, it's worth less the next minute, theoretically, than it was the minute you hit the button. And it's forever moving towards being worth less as time approaches expiration. So if you are holding the option and own it, you have to have the movement happen while you own it. But if you're short options, or in this case spreads, you're trying to bank on the simple movement of time to drop the value of the options, regardless of where the underlying is, as a way for you to capitalize. Position integrity after, and I said after, profit taking. There are many ways for you to reduce or modify risks without even necessarily adjusting your primary position. An investor can change their opinion in an ever-changing market using options. And one of the ways is if you have a stock position, you can use options to protect or generate income without affecting. Let's say you're someone who's got a long stock position that for whatever reason you plan to hold. There are ways to generate income, to modify or mitigate your risk based on the position that you hold. We have ways where you can, insure a portfolio with stock. But one of the other ways, and this is one of the things that I really like about options, is that if I'm long a call and the underlying goes up, let's go back. If I'm long a stock and the underlying goes up, what's the only way that I can profit? Well, I have to sell the stock. Therefore, I'm out of my position. But there are many ways that you can modify, roll, or leg your position, and all those things we'll talk about in my course. But what it allows you to do, if you buy a call and the underlying goes up, instead of necessarily just selling it out, you could sell an upside call, turn it into a vertical spread, take the option that you own, that you made money on, and roll it up into the next one. If you bought the 50 calls and the stock goes up to 60 or 58, you can sell out your 50 calls, buy 55 calls. You'll have taken some money off the table, but you'll still have the initial position that you had on previously in order to profit. You can't do that with stock. You can stay in trades longer. You can work them a little bit more. And again, this goes back to becoming options traders rather than options, someone who trades options. I'll give you an example. I was trading currency options in the cyber group, but I also did it my own account, I don't know, a couple of weeks ago. And I had I owned January, no, not January, they probably were October, let's say they were November. They were maybe November, 105 calls, but I'd sold the 111 calls. So I had a vertical spread on. I had bought the 109, 111 vertical spread. The underlying had moved up a little bit. It was trading around 109. And the one day I looked and realized that, geez, I bought this spread in order to minimize my risk at entry, but the underlying, the dollar versus the yen, again, these are FX options, not equity options, was looking kind of strong. and I looked at the calls that I was short, and I said, well, you know what? They're offered at 25 cents. And if any of you have heard me talk before, I'm a big believer in, hey, let's let somebody else make the last 25 cents. And that's what option traders do. Let's let somebody else make the last 30 cents. Let's not ride this thing to zero. Let's get out and give ourselves some more flexibility. Well, here's what happened. I buy those calls back at 25 cents, and then in a stroke of luck that never seems to go your way, and everyone's had those bad days as traders, everybody on the call, the underlying creeps up and trades around 109.77. So now I'm feeling kind of smart because those calls are now, about 40-cent bid. So all I've got are long calls. I own the 109 calls. I got just one position on. And the next day, the underlying gap's huge to the upside. And I was able to sell the 109 calls that I was long for a nice profit. But because I was an options trader, I recognized the value of, I had sold calls and they had gotten down to 25 cents by not being somebody who goes by what they learned from the reading Natenberg or being taught by somebody who read the Natenberg book. As a floor trader, I knew that there was no real upside in me being short those calls, because if they gunned to the upside, I would leave profit, I'd minimize my profit, and if I take it off, I'm only costing myself a quarter, and that's just a good value trade. And I was able to do that because options allow you that flexibility, that in and out. I had a guy I used to work for me, used to call it sort of like a chessboard to him. And he used to he'd move pieces around. If he was long some of these, he'd be short some of these, and moving them around and looking for value. So that is available to you in the world of options. It's not available to you if you're trading equities. Let me see if someone said that markets move up and down more often than they move sideways. Yeah, that's true now, the last few years. Ask the people in Japan where their market sat sideways for years and years and years. It depends. You have to adapt. There's no such thing as a one-size-fits-all strategy, which is why when we talked earlier, I said you really need to figure out for yourself what do you think is going to happen, and then try to apply the strategy based on current conditions that will best take advantage of that. You really just can't do that with stock. Portfolio protection, and I'm not going to, if you have let's say you have a retirement portfolio and the market's getting a little up there and you're getting a little bit nervous, you can use puts as an example as a way to protect that portfolio. It's one of the ways, if you're, even say you work for a company and a lot of your retirement is held in that company's stock, you may want to go out and try to protect your portfolio for whatever reason for a downside move. And let's give you an example. If you buy those puts and you're underlying, whether it be an ETF, a portfolio, the S&P futures, whatever it might be, or your simple company stock, if it goes down, as you lose money on that, the hedge that you put in place using the puts can gain value to offset it. That's one of the advantages we've got. And what happens is, if you buy these puts in this example as protection, all you need to do to get out of the trade is just sell the puts back out, and then you're back with your original position intact. Much superior to using stops, because again, they're working all the time, where your stops are only working while the market is open. I want to skip to this one. Here's an old chart, but it shows out the point. These gaps on earnings, negative gaps on earnings, what are we worried about there? We're going to show you here the protective put. In this example, at this point, the Dow Jones was trading at 127 a long time ago, 79, but a good example, so I keep it. The 112 puts, $15 below, were trading at $6.50. Well, oops, on January 15th, the Dow is trading at 82.18, and those 112 puts we bought were now worth $29.82, which was a profit of $2,332, protecting against the position that we had. In the Dow Jones example, we established a put position to protect our against breakdown below support. We bought the January puts for $650. We would vary it based on our portfolio size, and we'd use this money to offset the loss if we held the underlying. So this is something you can't do with stocks. It's a way to protect as needed. There are even people who use these. Let's say your company, again, let's say you work for a company, you work for GE or you work for Google or any of these companies, and earnings are coming out, or you, for whatever reason, have a long stock position that you want to hold for a number of years, but you're concerned about this earnings or this event. Well, you can go out and buy some puts, protect yourself, and then when the event's over, sell the puts back out. It's like a short-term insurance policy. Use them when you need them, and then sell them when you don't. There are income generation methods. These are the kind of things we'll talk about in the class. They are not possible with stock. Selling options strategically can provide an additional source of income because I said earlier, if you sell options, you obviously want them to go down in value. You'd like them to go to zero. What people will do is there's a trade called a covered call. And a covered call is if you own the underlying stock, you sell upside calls hoping that the underlying doesn't reach the level of that call, whereby allowing you to keep all of the premium that you sold the options for. And if you aggregate every month the premium that you sell, you can mitigate some of the losses you would take if your underlying goes down. We have lots of ways to generate income. This is just a taste. We'll talk about this more in the class. And I want to talk about the last one before we get done tonight. Market or noise cancellation. The toughest ground to conquer when becoming an options trader, or geez, for that matter, any trader, is the distance between your left ear and your right ear internally. It's you battling yourself mentally. As a trader on the floor, I stood there all day, every day, staring at a ticker. It would get to the point where you could tell what was going on the NASDAQ screen almost before it happened. You couldn't even tell why, because you just could see it because you had spent so much time. Well, the ability to have patience is a key attribute of a successful trader. Now, most people think of traders as get in, get out, get in, get out. Well, yeah, but get in and know when to get in and know when to get out. And let me give you an example. We talked about it in the cyber group, but we were looking at, back to the dollar yen, it had gotten up to like about the 109. This is before we bought the calls on the last story, but we were looking at it and it was trading around 108.70. And I said in the cyber group, hey, I just looking at the chart here, this looks like a trade that we should get a down move because of this and this, and I won't go into the details of why, but we were looking for a down move. And I said, though, it has been pretty strong. I don't know how quickly we're going to get this move. So I said, let's use options. So we bought some puts rather than necessarily trading in the FX spot market. And of course, almost as soon as I buy the puts, the underlying, you know where it goes up. And it trades all the way up to about 110.70, almost 200 pips away. Well, because I had set up this trade knowing what my max risk is going to be when I bought these puts, I bought them very inexpensively, I was able to wait out the move that we had. And what you'll see is that I had the patience to wait for the trade to go where I needed it to go. If I had traded this with cash, and you could change the scenario and make it a stock, I would have had to get out because I would have clearly set a stop that would have been, wouldn't have allowed me to lose 200 pips on an FX trade. But because I did it with options and I had 6 or 8 weeks until expiration, and I knew that even if I lost every penny of my option trade, I was still going to be, that was within my risk tolerance, I was able to gain some patience. And it allows you to wait out and gain that patience that you need to allow, again, within the framework of your risk structure, allows you to gain the patience you need to try to turn and wait for the trades to go your way. Also, I think it helps you maintain a positive psychology, and the biggest reason is when you enter the trade, you know exactly what your risk is. I'm harping on this point because it's critical. You have to understand, where am I going to get out? And then, do I have the discipline to leave that in place when the trade is in play? Well, if you master that, you can gain the positive psychology needed to conquer the distance between your left ear and your right ear. You're not as exposed. You're not at risk. When done properly, you understand and can quantify. Most times people get into trouble in life with the unknown. What did Nicholas Taleb call it in The Black Swan? The unknown unknown. Well, this is taking a lot of those unknowns and making them known because you know you've traded these options the way we talk about. You understand your risk. You understand the discipline needed to execute the trade, and then you act upon it. And that positive psychology, you've all had it when you feel like you can do nothing wrong, and then you have the opposite when you feel like you can do nothing right. The positive feeds the positive, and that's a great thing to have. You also want to take advantage of in fact, I did it today. I was looking for to put a particular trade on in there, even though I'd said earlier you wanted to maybe sell vertical spreads to capture time decay. I was looking at a particular trade, and I knew that because the way the model was set up and because really a lot of traders were already looking at it as Monday, there were some options on sale today. So the ability to buy stuff a little cheaper. It was funny, I was able to do a couple trades between markets that normally wouldn't happen, and that's because I knew that time was discounting the value of these options, because a lot of those market makers were probably already running sheets that told them it was December 1st instead of the 25th of November. Use that to your advantage because of the options. Most importantly, I think, or as important, is to stop tick watching. And this is two things. One, it allows you, because you've gained a little patience and you understand your risk, it allows you to get up from your screen literally and figuratively and not watch every tick. I will tell you, watching every tick of any underlying will drive you nuts. Talking to a guy who did it for over 10 years, it gets to you. But the other advantage is, in the world we live in, not all of us have the time to sit in front of our screens all day, every day to trade. The beauty of options, particularly as call it a swing trader, is you can get up from your screens, go about your day with our modern technologies and tablets and wireless devices and iPhones and all those sort of things. You can put on a position, have a stop loss and a target in your options, just like you would if you're trading an underlying, and walk away and not watch every tick because you know you're protected. Where it's really difficult is it's hard to walk away when you don't feel like your position is protected. And in the stock market, with it opening and closing every day, there is some risk, the overnight risk. All those things can be eliminated by using options. It allows you to stop watching every tick, look at the bigger picture, see the patterns, and try to develop strategies that will help you take advantage of them. And the final piece, the ability to scale in and out with options, to buy in small and increase the position, and as your profits start to go your way, scale out of a position. The scalability, because of the capital efficiencies which we began with, makes the trading options a superior way to trade any sort of moderate to long-term underlying. Well, guys, I appreciate everybody being with us tonight. It's been my pleasure to talk to you about this. We've talked about capital efficiency, superior alternative to shorting, limited loss, additional means of profit, position integrity, timely and flexible portfolio protection, income generation, market noise neutralization. Now, what I need you to do is hang with me, because we're going to be offering, and coming at the end of December, I'm going to be doing a specialty options. We haven't even decided what we're going to do yet, but we're going to take a strategy, a concept, and delve into it very deeply over 2 hours, probably 1 or 2 trading strategies. So keep an eye out for that. And then coming in January, we're going to start, again, live classes, phase 1, phase 2, phase 3, and phase 4 in January, February, March, or April. If you're somebody who can't wait and you want to jump all the way to the end and see how the movie ends, get with your educational advisors. They'd be happy to tell you how you can access some of our recorded courses. Here's a look at the people that we deal with, the tops in the industries. The Love, Thinkorswim, FXCM brought us here tonight, TD, Lightspeed, Trade Monster, Ninja, eSignal. You spent some time with me. We've talked about options. Let's talk about how you can make some money. Well, here's how you can do it. If you're really serious about being a trader, reach out to the educational advisors or use that web address at the bottom. Go to our website, and for 29 bucks, you can be in the trading group with Fausto. I'd come in at noon, talk about options, talk about FX, and see how traders are actually making money all day in the markets. We've got our screens up, the chat's open. It's a community that helps each other become profitable traders. And for 29 bucks, it will be the best 29 bucks you're going to spend. Most of you are going to probably spend more than that on coffee next week. So think about it. For 29 bucks, you can get your trading career off to a good start, or improve the career that you've begun by seeing how professional traders do it. People like you are profiting in the cyber group all day, every day. I like to jump in every day around noon, give a little update, see if there's opportunity in the FX and the option market. So reach out to your educational advisors. It's the best 29 bucks you're going to spend this holiday season, I promise you. There's the screens. You can always call our team at 877-70-CYBER. I'm going to leave this up here. In the cyber group, open Monday to Friday, 8 to 4, trade with Fausto. Watch the trading screens all day, market reviews, 2 daily live meetings. You can access meeting recordings. We send chats out. There's a Twitter account that they use to make sure everybody knows it. So I would urge you to do it. Please reach out to our team. I'm going to put that one back up there. So you have the link, 877-70-CYBER. Reach out to your educational advisors. This is Greg McDermott for Cyber Trading University signing off. Everybody have a great night.